Hello, everybody. Happy Sunday. Welcome back to Markets for Millennials. And this video is for the weekly recap from February 7th through the 11th, coming at you on Sunday afternoon instead of on Friday afternoon, as I was away for the weekend. And what I wanted to start off with is just taking a look at the yields. When we look at the charts, we'll start with the yields. But before we get into the charts, just a few things that have been happening here. So we'll start with Thursday. We had a really big news event on Thursday that the markets were anticipating, and that was the CPI. And the CPI year over year ended up coming in at 7.5%. And that was higher than expectations. It's higher year over year than the reading from last month's CPI report. And so the markets, it was an interesting response. We'll talk through it when we look at the charts. But that was something that was a really big deal. And then we barely were on the heels of that. So let me start with this. So coming off of that CPI report, we had one of the Federal Reserve officials from the St. Louis Fed, James Bullard, who he is the most hawkish. So whenever it's really interesting to think about whenever there is a story about yields and about inflation, one of the people who is often sought for their opinion, for their questions, is James Bullard, and he is the most hawkish of all of the Fed presidents. And even going back, I was looking through some articles, even going back into like September and October of 2021, he was talking about two rate hikes in 2022, which at the time all the dot plots were showing, maybe one rate hike in 2022, but setting up for multiple hikes in 2023. And obviously Bullard was the most hawkish. And now he's talking about getting multiple rate hikes. He is talking about wanting a half a percentage hike in the March Fed meeting, and then another two consecutive 25 basis point hikes in the next meetings after that, so that by the time July comes, there will be a 100 basis point rise by the time July comes. I'm trying to figure out if they talk about it in this article. I don't believe so. So he came out right after that CPI print, and talked about looking for those big rate hikes instead of 25 basis points in March, asking for 50, and then multiple rate hikes in the consecutive months. And obviously, we'll talk about on the charts what happened, what the markets did in response to that. Then we had a really eventful Friday where we had the story came out that multiple Fed officials, privately and publicly, as you see here, pushed back against Jim Bullard, talking about a more measured, whatever this means for them, a measured approach. So I guess the idea is they're talking about obviously getting the first hike up, starting with this 25 basis point increase, um, and and so basically what they're talking about is, I think what this article is saying is that most of the Fed officials they came out right away, because the markets um, obviously reacted the way that they did. We'll talk about it. And the Fed came back and pushed back, like they're trying to control the narrative. Um, and so that's something that we had to take into account. So this was Friday morning. And then shortly after that came out, we started getting these reports. Um, this report came out. The U.S. believes Putin decided to invade Ukraine and communicated those plans to the Russian military. And obviously, there's lots of speculation about this, a lot of people pointing out the fact, and reasonably so, that if Russia was going to do something, I don't think that they would, that they would tell that they would talk about it, that it would be publicized on Twitter so that everybody could know exactly what they were doing and when they were going to do it, right? So it says here they expect the invasion to begin next week, and so a lot of people have been pointing out how um, it seems strange that the Russians, if they were actually going to do this, that they would telegraph it this way. Um, and so this is something I'm going to reference and as we talk through the charts. And then something that I kind of posted, and actually I don't even know if this is going to show up now. Oh yeah, good. So um, one thing that I was noticing as a result of on the same day of the CPI, um, so we had, let's see, so this was actually on the 11th, so this was just a few hours at 10:40, a few hours after that report came out about the Fed taking a more measured approach. I had posted this tweet: big day for the Japanese yen, risk off in forex, gold up, equities puking, Bitcoin down. And that was in response to kind of what had been going on, partially as a result of obviously the Fed story about taking a measured approach, but then also with what was going on with this Russia-Ukraine scare. And what was interesting is that I had previously posted, and I'll click on this tweet, I had previously posted the day before, like the night before, that what was interesting coming off of the CPI report was that I had this chart that I posted about the Australian dollar Japanese yen and also the New Zealand dollar Japanese yen. And I talked about how both of those had been rejected off of that resistance, which is coming from mid-October of 2021. Kind of on both charts, obviously you can see like some of the structure looks a little bit more shallow on the Australian dollar Japanese yen than on the New Zealand dollar Japanese yen. But both of those currency pairs are really good indicators of whether risk on or risk off is taking place in the market. So in risk on environments, more speculatively friendly environments, the Australian dollar and the New Zealand dollar will increase versus the Japanese yen and also the Swiss franc. But I was particularly struck by the fact that this was happening versus the Japanese yen, and so I thought that was a really important thing to point out. And so when it came to that was off again the CPI, and then the next day when we had the Ukraine-Russia news, we saw continued follow through. So now let's take a look at the charts with all of that context in mind. And what I thought I would do is start on the yield chart, because if we pull back, we had the initial sell down, which was part of the crash, the March 2020 crash. The yields came down. It was highly deflationary. Then we had the initial spike, which came from the Fed response, the anticipated Fed response, and then obviously we came right back down, and we kind of stuck around down here, bottoming in August of 2020, and then slowly we were on this bull run all the way through, and we've had various lines. For a long time I was following. That's really bad, but I was following something closer to that for quite a bit of the year, and then obviously right around this area we broke down, retested it, and it looked like we found a bottom right here, which was a really good level, just horizontal resistance wise as well. And that's when I redrew this trend line to attach to the bottom here, and you can see that it has provided support on a couple of other occasions, and slowly and surely it has come back up. And I talked about kind of all throughout this period of time, I had been talking about how the rise in yields that we saw kind of in this period in early 2021 can happen very, very quickly. And so it looks like that's what we've been seeing basically since the end of December of 2021. And then we had a little consolidation. You can see this sideways triangle. That was a bullish consolidation. We were able to break out of it. And then what was interesting is, if you followed my last few updates, then what you have seen from me is that I've talked about how this level, this approximately around the 2% level, was a super important level, because that level has provided an approximate level of support and then resistance in previous years. So you can kind of see that in play over here back in September of 2017 as support, resistance back in March of 2016. And so if you follow along, you can see that that 2% level has been toyed with multiple times over the years, especially over the last 6 to 7 years. Whoops. So I talked about that being a level that was really important, that I thought if we got above that level, that the markets would get a little tumble, because I think that the Fed would be forced to that would what that would mean is that yields being that high would start to cause pressure on the markets, and that as a result the Fed would have to step in, and we would get these yields to come down a little bit. And it's really interesting. I'm still reflecting on this and really trying to think through what this all means. And so I don't claim to have the answers, and so don't take what I say as truth, because I'm just calling it. I'm kind of just like looking at it as the way I see it right now, the way it seems to be presenting itself. We all know that the Fed has tools, easing tools and things like that, and that what happens in easing is we get these yields to come down, and in the environment where the Fed is monetizing the debt and all that, you tend to get those yields coming down with QE and stuff like that. But the problem is that the Fed is in a tight spot because of the employment numbers, which, you take that for what they're worth. Maybe they're manipulated, maybe they're not. You have that running hot. You have inflation running hot. So the Fed is in a little bit of a bind. You also have the debt to GDP, which is something Lynn Eldon talks about a lot on Twitter. Great follow. And so the Fed's in a tight spot. And so it's really interesting to think about, as you look at this chart, what has happened, what has transpired over the last week. So on the 7th, right, so we had this huge candle on Friday the 4th last week. And then what I was looking for last week was, are we going to hit this 2 level, the approximate level, and what's going to happen once we hit that? So we had a couple of days up, we had a day down, and then we had a huge day up on the CPI print on Thursday on the 10th. And we actually got above that 2 level, up to a high of, let's see, our high was 2.054%. And then what was crazy was on Friday, initially, we got a print over 2.06, and so just barely above. And then as the days went on, so let's see if I actually let me go to a 1 hour. Right. So as the news started to come out, that so like right around this time, these 3 hourly green candles came right on the heels of the Fed kind of backtracking what Bullard had been saying about the bigger rate hikes. And then what was interesting was that it's interesting that yields did that, as it talked about the more hawkish the more dovish rate cutting versus what Bullard was promoting. And then on the news, as the news started to come out, around midday Eastern time, you began to see the yields really sell off, or really sell down. And so you kind of see that progression take place. And that actually, it wasn't just yields, it was the markets in general. And so I'm wondering if, and I haven't had enough time to go back over the last few days to really look at the history of the yields to see what happens when there seems to be geopolitical instability or geopolitical scares. And so I haven't had time, so I'm not 100% sure what to make of this, but I think it's very interesting. My question is, will yields come down if this Russia-Ukraine situation continues to be exacerbated? And it seems very strange that the U.S. government is making it, it almost seems like the U.S. government and people in the U.S. media are kind of fanning the flame, putting, maybe scare tactics, maybe some misinformation. Russia came out and said, "Hey, like your media is spreading lies." I mean, obviously it's a Russian, so you have no idea like what to take about that, um, or what to make of it. But we got this big giant engulfing candle down, um, and closed at the bottom of that range, and so we'll be looking to see where yields open, and kind of what happens over the next week. I don't remember. Let's see. So again, on this tweet, will there be an invasion next week? Are we going to get? Is something going to happen geopolitically next week, or is this going to turn into nothing? And the jury's still out on that. I don't know. I don't have the crystal ball there, but it is something to watch for sure. And so it's hard to really see what impact yields had in this case, either to the upside on Thursday or to the downside on Friday. What impact they had on the markets, because if I come over to the S&P, when yields went up, we had a red day, even though the market was kind of up initially, or had retraced quite a bit of an early loss on the CPI print. Um, and then but then we had another red day down, and in fact the red day on Friday was worse on the S&P than on the previous day. And so obviously geopolitical news was cause for concern. That's kind of why I mentioned this whole thing about the U.S. dollar, or I'm sorry, the Japanese yen, the risk off in forex. Along with that, so let me go back to the charts. I'm going to skip over to gold for a second. Gold had a really monster day, up over 1.5%, up $32, and gold just. I talked about this. I think gold's time is coming. I have talked about some disappointment with gold, and when I talked about this sell down from gold, I thought I asked the question, okay, was I wrong? Did I think, was I too early on gold? But we still continue to make higher lows, and at least in this more recent period of time, higher highs. And so what I'm looking for here is over the next week, are we going to get a higher high from this stretch of time in mid-November, in maybe the second third of November, and we'll see if we can get above that. And the level that I'm looking for to the upside, considering where we're at now, once we can get above this kind of this level from mid-November, I'm looking to get above 1916. And so obviously with geopolitical risk, going to gold is that's the flight to safety. And then like in the currencies, into the Japanese yen and the Swiss franc, that's typically what happens. So all this geopolitical stuff, and actually I need to fix this. I need to make this support now. So all of this stuff has basically kind of followed the narrative of what happens when there's geopolitical risk, and risk of major disruption in the world. So you've got, again, that the gold going up. Silver was up about the same amount. I got to change this as well. Silver hasn't quite made it above the level that I was watching on that you can see that trend line that's coming down. And then I've got a couple of levels listed out here that I'm really watching closely. But the precious metals having positive days with the geopolitical risk. I'm actually kind of surprised that silver had such a good day. Because typically like silver is more speculative. Silver has some different things about it than gold. Typically you don't see the move into silver quite as much, being quite as heavy as the move into gold on a percentage basis. But you do see that in this case. So I think that's really interesting. So back to the S&P. What I did, and I did this on all of my equities charts. I had, let me show you on the Nasdaq. I had a trend line basically here. I just adjusted it to go in line with kind of the top end of this candle, this red candle, which was from February 10th, the CPI print day. And so, again, as we just take a quick gander at the equity indices, I made that same adjustment here. You can see like my line was right here, and then I just moved it up to here. You can see that same thing taking place on the equity markets, where you basically had a a red day on Thursday, which if you go to intraday, so let me go into a 1 hour chart, and this is the futures, so it's a little bit different. So we had the CPI print come down. Price came down on the CPI print on Thursday morning, and then came down further, and then kind of came right back up and retested that level that it had started that downfall at, but then just continued to sell off throughout the day. Started to come up on kind of the retraction of when the other Fed presidents and other Fed insiders started talking about, no, we're not going to raise rates at the rate that Bullard was talking about. We started to come back up, and then obviously again the geopolitical news comes out and things just puke. And so that's obviously a look by using the Dow, but you saw the same thing happen everywhere. Where the fall was most muted was on the Russell. But as you can see, the Russell has underperformed significantly for a long time. We're actually in a much deeper correction from this little prairie dog top from to the bottom. We went over 23%, and as we stand, we're at about 17.75%. So, so obviously the Russell has taken a lot more structural damage. So on all the indices, again, so much of it depends on how the market perceives what's happening with the Russia situation, and it's not just simply about what actually is happening. It's also about, I think what the market is going to really care about too is the perception of how the Biden administration is going to handle it. Does the Biden administration look very inept? And I think that if they do seem inept or helpless to do something about the situation, then that can cause turmoil. Obviously, if the U.S. Responds with some sort of strategic strike, if there is even anything to strike at, or any reason to strike, then obviously that can cause instability. But it may turn out that this is absolutely nothing. In fact, I think, if I recall, sometime this weekend, I haven't been able to catch up on the news, Biden was supposed to have met with, I believe, either the officials of Russia or the officials of Ukraine. So that's something to be apprised of. But definitely, actually, and let me go back to the S&P. I'll turn on my moving averages that I've been watching. And on the S&P, again, this is something I talked about. Now, this is part of what you have to understand is the context, which again is that CPI print and the Russia news. But again, if you go back to the March 2020 crash, on the S&P, we came down below the 200, came up, retested close to the 100-day moving average, and then ended up selling back down, making a lower low. And as you see here, what we kind of have is we've got the early stages, although on a longer time frame. Like it's taken more days for this to happen, but we came down below the 200, popped up, and have retested now twice the 100-day moving average, and now we've closed below the 200. And so what I'm watching for, let me just throw some levels here just so that you guys can see what I'm looking at. I think obviously this is hard on the S&P because you can start from the closing low around that area, around 43.19, 43.20-ish, 43.15. Or you can go to the lowest red wick. Wow, that was really bad. Sorry. You can go to approximately the lowest red wick. That's still really bad, which is closer to 42.65. Or you can go just to the lowest wick period, which is about 40. Let's see, what is this? It's about 42.15. So if we make a lower low, then obviously that's not going to be good. If we make a lower low, then that's going to be below 12.5%. So back into correction territory. As we currently stand from the high, we're only down about 8%, a little over 8%. So on the Nasdaq, kind of the same kind of thing, although I think the Nasdaq's at higher risk. So again, you can mark either the lowest close, the lowest red wick, or the lowest wick in general, and those levels are going to be levels I'm watching. And you can again see the where we're at under all the moving averages. Let me go back to the Nasdaq. Again, this one we came up and tested the 200-day moving average, and failed to get a good retest above that. That's actually different than what happened on the initial bounce. So something to watch previously. So making the lower low there, you can see that we've crossed the 50-day moving average, just crossed the 100, so momentum is clearly down. On the Dow, same thing. Although we did get two closes above the 50-day, and momentum had looked like it was returning. You see that the 50-day moving average actually turned up, but now we are once again closed below. And I had talked about that as the moving averages get closer together, be prepared for momentum to swing wildly in one direction for a decisive market move, either to the downside or to the upside. And it looked like for a second we were going to get a decisive move to the upside, but obviously that has not happened. And then, because that's kind of what we saw in the Russell here too. We kind of stuck together for a while, got a quick move up, sold down, and then boom, down. So I'm going to do the same thing. Although I'm not as concerned with watching the Russell in this case because it's underperformed so much. So we're going to watch this level here and this level here. So keep those lines there. Taking a quick look at the dollar index, turning the moving averages off. We've had this line, and if you followed my channel, you know I've been watching various lines. This has been the lowest line now, kind of adjusted it down to hit this kind of red wick. We've not yet broken down below this level, but there are still, and I know Jordan Lindsay on Twitter and on his live streams has been talking about really important dollar levels, so go ahead and give him a follow and consider signing up for his training course, because the level of detail is really not surpassed by anybody, and the focus, especially on where the dollar index is at, really solid analysis. So currently we're watching this bottom line first, and then a couple of horizontal levels of support that the dollar would have to break through before potentially heading to lower levels. And so, but yeah, it'll be interesting to see if we're going to get a dollar milkshake, which is kind of like what happened up here. The dollar will eat all currencies if we have substantial risk, and so that's something you want to watch out for. And obviously, a stronger dollar is probably not very good for, especially growth stocks, like in the Nasdaq. It doesn't mean that the markets can't go up, but that is something to watch, because sometimes, obviously, you do have the dollar will be rising and markets will rise with it, and sometimes it's not. So definitely something to watch. Bitcoin was doing some really interesting things on the CPI print. We actually were getting really close to. We did get a breakout. Obviously, recently I had been watching. Let me see here. I had been watching basically. Let me not do that. Let me actually do a straight line. I had been watching something like basically this. Let me get this darkened out. I have been watching that. We obviously tested it, broke through, and we're currently on the correction of this impulse. It looks like we were breaking up. What I did, I can darken this, but what I basically did was, if we do make a lower low, if this buy impulse gets faded and we make a lower low, then this line is going to be important as a level of resistance, just like the lines were on these other wicks over here from December 27th and January 20th and February 1st. So we'll be watching that. And then what I did here is I'm kind of watching two lines on Bitcoin. I'm watching connecting the red wicks, and then I'm connecting the bottoms. So one of them is obviously more shallow, one of them is more steep. So what you want to see for this trend to continue is you want to stay above, preferably for me, I want to stay above the steeper line, but all hope will not be lost if we stay above the more shallow line as well. So be watching that level on Bitcoin. Again, if you're in a position of power, meaning that you got in early and you're not in a position where you have to, where, you know, if you didn't buy kind of on the top end, then that's the position of power I'm talking about. So you have the luxury of waiting. I don't personally leverage trade Bitcoin, even in its upswings. That's just something I've decided for myself I'm not going to do. So I cannot give any advice on that, and I will refrain from doing so. But that's my look. I actually think, unless things get unruly with the Russia situation, which it totally could, I actually think just thinking about what's been happening this weekend, because I haven't really checked price until just now on Bitcoin, but we obviously had the CPI print. We sold down and then actually came up, and we're up pretty big on the day, and then it ended up being a really big down day. And then we had some follow through to the downside on the Ukraine-Russia news. And then what we kind of got a small candle to the downside here on Saturday on low volume, and here on Super Bowl Sunday we are kind of slowly, like barely in the green, and so it's totally possible this could curl back up and we can get this continued move up. But if things geopolitically are not good this week, we could totally sell down. And so you always want to be aware of your downside risk. What I can say on trading, if you are trading, then if we were to say if you drew that line that I had here, let me put it back up. If you're looking for entries, since we are in a correction of this move right now, if you are looking for an entry, then the only places, like the safest place, I'll talk about three places you could put a stop loss. The safest place would be to put a stop loss below the bottom of this wick from January 24th. That's the safest place. The next place that you could put a stop loss would be just below the wick of the February 3rd candles. That would be right about here. And then the next, the most risky place on a trade, again, and that's if you break this trend line, then the next place would be to put if you're much more aggressive, to put a stop loss down right below the wick from February 12th, which is yesterday's wick. Those are the three places that make sense to put a stop loss on a trade. Obviously, your position size is always the same. And from a risk standpoint, you risk a lot more if you use that stop loss, that stop area, that range. It's much less risk, but also much less reward if you take the safe entry right there. So, or the safe stop loss there. So those would be levels you would look at, and then obviously oil, just huge days above. We got oil above 90, and we actually came down, and then just really, really big up day on the 11th, which was obviously that Friday print. The reason why oil goes up and why a lot of commodities go up is because if there is potential war situations, then there's obviously going to be military usage of oil, scarcity, potential like shut-off risks. Russia does control a good supply of oil, things like that. So obviously something to watch. I'm not chasing this momentum, but there are a lot of people out there who believe oil is going to go to 150 or 200 or even beyond. So I could see that situation playing out, but obviously, you either, if you're looking more long term, then you just close your eyes and buy. If you are more trading, you never know if this could come down or not. So you have to look for a solid entry and then use wise stop losses and proper risk management. So a little bit longer than some of the previous videos have been, but obviously there was a lot going on, so I think it was worth the analysis and worth the look. So Gave you the levels that I was watching, the items that I was watching. I hope you guys are all safe this week. I hope you guys are successful in your trades this week and in your investing this week. Be careful out there. Please manage your risk wisely. And I will see you guys later this week. Have a wonderful rest of your weekend and a great week.